Florida's housing market collapse is no longer a theory. It's an undeniable reality unfolding in real time. What's even more alarming is the speed at which entire communities are breaking down. Signals that once looked like normal price adjustments have turned into visible structural cracks from Miami to the Panhandle. Homeowners earning $150,000, once securely middle class, now find themselves outbid, outpriced, and overwhelmed by cash-driven investors and exploding insurance premiums. In some counties, annual insurance now rivals mortgage payments, pushing affordability past the breaking point. When carrying costs exceed economic value, markets don't cool, they reset. And today, that reset is accelerating fast. In this investigation, we break down the 10 Florida cities under the greatest pressure, the markets where affordability gaps, insurance risk, and shifting migration patterns have combined into a perfect storm. And we begin that countdown right now, starting with number 10. Number 10, Daytona Beach. Daytona Beach has always carried a certain promise. Long stretches of Atlantic shoreline, iconic motor racing, and a lifestyle that once felt attainable for middle-class families. But in 2025, the numbers tell a very different story. What was once a stable, working-class coastal market is now one of the fastest correcting cities in Central Florida. Home prices peaked around $385,000 during the boom. Today, the median sits near $342,000. An 11% decline that masks deeper weakness. Homes that once sold in bidding wars now sit for 80 to 95 days, and price cuts have become standard across the market. Inventory has surged more than 140% year over year, signaling a clear shift from scarcity to oversupply. The real pressure, however, is insurance. Premiums that averaged under $4,000 a year now routinely exceed $8,500, even in neighborhoods far from the beachfront. For many homeowners, insurance alone now costs more than their mortgage. That shift has broken the affordability foundation Daytona relied on for decades. Higher costs are triggering a reset. Investors who bought aggressively in 2021 and 2022 are offloading properties at discounts. Retirees who once counted on modest living costs now face premiums, assessments, and taxes that have outpaced local incomes. And as more listings hit the market, each reduced sale becomes a new comparable that drags surrounding values downward. The vulnerability is structural. Daytona's economy depends heavily on tourism, service sector jobs, and moderate wages, sectors that cannot support coastal-level ownership costs. Without a substantial increase in high-income migration, the market must adjust to the reality of local earning power. Daytona Beach isn't collapsing because demand disappeared. It's correcting because the cost of staying has risen far beyond what residents can sustain. And with insurance still climbing, inventory still rising, and buyers turning cautious, this reset is likely only in its early stages. Number 9. Deltona. Deltona was built on one core promise: affordability. It offered oak-lined streets, quiet cul-de-sacs, and a cost-of-living advantage for Orlando commuters who just wanted space and stability. But in 2025, that promise is collapsing under the weight of rising ownership costs and a market that pushed far beyond what local incomes can support. Home prices peaked at $398,000 and have now slipped to $361,000. A 9% correction that looks small on paper but represents a deep shift in momentum. Days on market have stretched from under 30 to more than 75, signaling a market where buyers have stepped back and sellers are adjusting expectations month after month. The real break, however, comes from carrying costs. Insurance premiums averaging more than $7,200 a year, combined with HOA increases of nearly 40% over 3 years, have erased the affordability advantage that once defined the city. Instead of being a refuge from coastal volatility, Deltona is now priced like a high-risk market, without the benefits of tourism, coastal appeal, or high-income job centers. At the same time, Volusia County is seeing a surge in property property tax appeals from homeowners whose assessed values no longer match market reality. When those assessments eventually fall, the county will face revenue gaps that historically lead to service cuts, a cycle that depresses demand and pushes prices even lower. Deltona's deeper vulnerability is structural. The city depends on commuters earning $45,000 to $65,000, but the median home now requires closer to $95,000 in annual income to comfortably afford. That gap is too wide to sustain, and the market is recalibrating accordingly. Today, Deltona is entering a slow, grinding correction, rising inventory, falling demand, and ownership costs that continue to outpace local wages. It's not a dramatic collapse, it's a quiet, steady unwinding. But the direction is unmistakable, and the market hasn't found its bottom yet. Number 8. Sarasota Inland Areas. Sarasota's coastal glamour still draws the headlines. White sand beaches, waterfront condos, and a luxury market that continues to attract wealthy buyers who can absorb rising costs. But just a few miles inland, a very different reality is taking shape. Northport, Englewood, and the broader inland corridor are now seeing one of the sharpest affordability resets in Southwest Florida. Home values that surged during the pandemic boom have begun unwinding at a rapid pace. Median prices have fallen from $492,000 to roughly $438,000, an 11% decline, with month-to-month data showing further softening. Days on market have climbed to nearly 100 compared to single-week sales during the frenzy. The inland market has shifted from competition to caution, and buyers are no longer willing to stretch for prices inflated by out-of-area migration. Insurance has become the core destabilizing force. Despite being miles from the shoreline, many inland Sarasota properties now face annual premiums approaching $9,000 or more. Updated flood zone models and hurricane risk algorithms have pushed inland rates into levels once reserved for coastal homes. The result is a growing affordability gap. A median inland home now requires an income far above what most local households earn. At the same time, inventory has expanded sharply. Inland neighborhoods, particularly newer subdivisions built between 2005 and 2017, are seeing rising listings as homeowners struggle with rising premiums, taxes, and HOA costs. Each discounted sale resets comparable values across entire communities, accelerating the downward pressure. Structural vulnerabilities amplify the shift. Inland Sarasota lacks the wealth influx and cash-heavy buyers who help prop up the coastal market. When carrying costs rise and demand thins, values must adjust to what permanent residents, not seasonal buyers, can support. Inland Sarasota isn't collapsing because of a lack of appeal. It's correcting because prices, insurance, and wages no longer align. Until those fundamentals reconnect, this part of Sarasota County will remain one of the most exposed markets in Florida's ongoing housing reset. Number 7. Punta Gorda. Punta Gorda has always carried the image of quiet Florida living, calm canals, peaceful mornings, and a retiree-friendly pace that rarely made headlines. But beneath the surface, this once stable market is undergoing one of the sharpest structural resets in Southwest Florida. The turning point wasn't gradual, it was Hurricane Ian. The storm didn't just damage homes, it triggered a complete reassessment of financial risk. Insurance carriers withdrew or raised premiums to unprecedented levels, leaving homeowners with costs that fundamentally changed the economics of living here. Median prices have dropped from $425,000 at peak to about $367,000, a 13 to 14% correction that continues to deepen. Days on market have stretched well past 90, signaling a market where buyer urgency has evaporated and sellers are adjusting expectations every month. But the core crisis is ownership cost. Insurance premiums that once averaged a few $1,000s have exploded into the $12,000 to $15,000 range, with some policies even higher depending on elevation and construction. For many households, insurance now exceeds the mortgage payment. a scenario no market can absorb without correction. Condo owners are under even more pressure. Post-Surfside structural inspections, hurricane mitigation mandates, and new reserve requirements have led to massive special assessments, often tens of thousands of dollars per unit. Rising delinquencies in some buildings are forcing associations to raise monthly dues, pushing more owners to list, creating a dangerous cycle of cost inflation and declining property values. Inventory across Punta Gorda has ballooned as owners, unable to sustain rising costs, try to exit at the same time. But demand is thin, especially among retirees and fixed-income buyers who once formed the city's foundation. Each discounted sale resets comparable values, ensuring the correction spreads across neighborhoods. Punta Gorda's downturn is not a temporary slowdown, it's a structural unwind. When insurance, assessments, and taxes climb faster than incomes, the market moves in one direction, down. And for Punta Gorda, that reset is still unfolding. Number 6, Fort Myers. Fort Myers was one of the fastest-growing cities in America during the boom. Its rapid suburban expansion and aggressive in-migration once made it the poster child of Florida's housing surge. But today, signs of structural weakening are showing up everywhere, driven by rising costs, post-hurricane rebuilding pressures, and an insurance environment that has fundamentally reshaped affordability across Lee County. Home prices in Fort Myers have dropped more than 11% from their 2022 peak, falling from the upper $400,000 into the low $400,000 range. Days on market have stretched dramatically, shifting from the bidding war frenzy of the pandemic to a slow, cautious market where listings sit for months. That shift isn't sentiment-driven. It reflects a deeper mismatch between what homes cost to own and what local incomes can sustain. Insurance is the central force behind this reset. Premiums that once ranged between $2,500 and $5,000 a year have been replaced by renewal notices in the $12,000 to $15,000 range. Even structurally sound homes face steep increases due to regional risk reassessments and climbing reinsurance costs. For many buyers, insurance now exceeds the mortgage payment, turning ownership into a financial strain rather than an investment. Compounding the pressure are hurricane-related assessments. Many communities, especially older buildings, face significant repair obligations tied to flood mitigation, roof replacements, and infrastructure upgrades, often amounting to tens of thousands per unit. These costs shrink the qualified buyer pool and drive more price concessions as owners attempt to exit before carrying costs climb further. Inventory continues to rise as sellers adjust expectations. Price reductions are frequent, appraisals conservative, and buyer demand hesitant. Flood zone reclassifications have further expanded costs in previously lower-risk neighborhoods, adding another layer of affordability pressure. Fort Myers remains a desirable place to live, with strong amenities and natural appeal. But the economics underlying the market are shifting. As carrying costs outpace incomes and insurance resets reshape valuations, Fort Myers is moving toward a necessary correction, one that reflects fundamentals rather than momentum. Number 5, Lakeland. Lakeland was once marketed as Central Florida's affordable escape, a city offering real homes without coastal insurance premiums, positioned perfectly between Tampa's job market and Orlando's theme park economy. For years, it worked. Lakeland became the go-to option for families priced out of the coasts, but still wanting space, stability, and predictability. But in 2025, the foundation that held Lakeland together is breaking apart. Median home prices have fallen from $368,000 at peak to $324,000, a sharp 12% correction that reflects a deeper structural imbalance. Days on market have quadrupled, rising from just 22 during the frenzy to more than 80 today. The buying urgency that once defined the I-4 corridor has evaporated, replaced by caution, withdrawn offers, and widespread price reductions. But the real pressure is coming from insurance. Lakeland was supposed to be insulated from coastal volatility. Instead, inland premiums now average $6,800 plus annually, rivaling some Tampa Bay suburbs. Updated hurricane risk models treat treat Lakeland as part of the statewide exposure zone, erasing the cost advantage that once defined it. Add rising HOA fees, higher property taxes, and elevated maintenance costs across aging subdivisions, and Lakeland's affordability collapses quickly. The market numbers confirm the strain. Inventory is up more than 150% year-over-year in Polk County. Sellers who listed optimistically in early 2024 are now cutting prices, often multiple times, as appraisals fall and buyers wait for deeper correction. Each reduced sale resets comparable values across entire neighborhoods, creating cascading downward pressure. Lakeland's income base intensifies the vulnerability. Local jobs, logistics, warehousing, teaching, healthcare support typically pay $45,000 to $65,000, yet median homes now require $85,000 to $95,000 in income to comfortably own. That gap is mathematically unsustainable. Lakeland isn't collapsing overnight. It's unwinding in slow motion. An overheated market pulled back to reality by insurance instability, wage limitations, and the simple math of affordability. And with inventory still rising, Lakeland remains one of Central Florida's most exposed markets in 2025. Number 4. Ocala. Ocala has long been marketed as one of Florida's last affordable strongholds, a quiet inland city built on rolling horse farms, slower-paced neighborhoods, and the promise that families could own a home without coastal-level pressure. But in 2025, the foundation beneath that promise is shifting fast, and the correction underway is deeper than most analysts expected. The first cracks formed when pandemic-era migration pushed prices far beyond what Ocala's local economy could support. At the peak, median values reached $342,000, a dramatic departure from a market anchored in healthcare, logistics, and service sector wages. Now prices have fallen to around $298,000, a 13% decline signaling a structural reset rather than a temporary dip. Days on market have tripled, rising from the low 20s during the boom to more than 90 as buyers pull back. But the true pressure point is ownership cost. Insurance premiums, once an advantage for inland cities, have surged to roughly $5,400 annually, more than doubling in a short span. Property taxes remain elevated even as valuations fall, putting homeowners in a tightening financial squeeze. Ocala's diverse housing stock adds volatility. Manufactured homes, older subdivisions, and mid-tier ranch properties are all declining at different speeds, compressing values across entire ZIP codes. Inventory continues to climb, with more sellers reducing prices multiple times as appraisals come in lower and demand weakens. This is the same pattern Marion County experienced during the 2008 crash, when prices ultimately fell more than 50%. The underlying vulnerability hasn't changed. Local incomes simply can't support speculative price levels for long. Today, Ocala is unwinding in slow motion. Insurance models remain in flux, wages lag behind ownership costs, and rising inventory ensures further softening. The lifestyle that made Ocala appealing is still intact. Open space, equestrian culture, peaceful neighborhoods, but the housing market beneath it is recalibrating toward an affordability baseline that hasn't been reached yet. Ocala's correction isn't finished. The numbers all point in one direction, down. Number 3. Kissimmee. Kissimmee sits just south of Orlando, where short-term rentals, theme park tourism, and investor activity once powered one of Florida's fastest-rising housing markets. For years, homes here weren't bought for long-term living. They were bought for income. And as long as tourism stayed strong and financing stayed cheap, the model worked. But over the last 2 years, that foundation had weakened in ways the market is still struggling to absorb. The first major shift came from the short-term rental slowdown. Occupancy rates fell back to pre-pandemic norms, nightly prices softened, and platform competition increased. Investors who once counted on steady revenue suddenly found themselves collecting less while paying more, especially as borrowing costs climbed. With thinner margins, many owners began offloading properties, and Kissimmee's inventory ballooned far faster than neighboring cities. The pricing impact has been sharp. Median home values have fallen from roughly $428,000 at peak to around $362,000, a correction of just over 15%. But in rental-heavy neighborhoods, the declines are steeper, with some clusters reporting drops of 25 to 30% as multiple owners attempt to exit simultaneously. Each discounted listing resets comparable values, accelerating the downward pressure. Insurance has intensified the decline. Premiums for rental-classified properties across Osceola County have surged beyond $8,000 a year, pushing many units into negative cash flow territory. When the cost of ownership rises while income falls, properties shift from assets to liabilities almost overnight. This imbalance has changed buyer behavior. Homes that once sold within days now sit for months, and sellers are increasingly forced into multiple price cuts just to attract showings. Appraisals have turned conservative, and lenders are less willing to finance inflated valuations in investor-dense communities. Kissimmee's correction is not driven by a lack of demand for housing. It's driven by the collapse of a business model that depended on constant tourism, cheap financing, and predictable insurance. As those pillars weaken, the market is resetting to levels local incomes and stable long-term demand can actually support. Number 2, Daytona Beach Shores. Daytona Beach Shores sits on a narrow stretch of Atlantic coastline, lined with high-rise condos, beachfront towers, and a housing market once powered by steady retiree demand and out-of-state buyers. But in 2024 and 2025, this market has shifted sharply, driven by forces that are now reshaping coastal Florida housing as a whole. The most visible change is pricing. Median condo values have fallen from roughly $625,000 at peak to about $498,000, a decline of more than 20%, placing Daytona Beach Shores among the hardest-hit coastal cities in the state. Days on market tell the same story. Units that once sold within weeks now sit for 4 to 6 months, often undergoing multiple price reductions before receiving an offer. Insurance is the key pressure point. Annual premiums for oceanfront condos now frequently range between $18,000 and $25,000, driven by updated hurricane risk models, higher reinsurance costs, and broad reassessments following recent storms. For many owners, insurance alone consumes a significant portion of monthly housing budgets, even before factoring in mortgages. Compounding the problem are post-Surfside structural regulations. Updated milestone inspections, concrete restoration, and reserve mandates have resulted in special assessments commonly between $35,000 and $65,000 per unit, with some buildings facing multi-million-dollar repair requirements. These costs have pushed carrying expenses far beyond what many owners can sustain, especially retirees and fixed-income households. As a result, inventory has surged. Listings across Daytona Beach Shores are rising quarter after quarter as owners attempt to exit before further valuation drops. But demand has softened significantly, particularly as buyers grow cautious about long-term affordability and the unpredictability of insurance costs. Each discounted sale resets comparable values for the entire building, and often for the block. The structural vulnerability is familiar. During the 2008 to 2012 downturn, this same coastal strip saw deep price collapses and high foreclosure rates. Today, elevated insurance, mounting assessments, and slower demand have recreated the same pressure environment. Only now, the financial stakes are higher. Daytona Beach Shores is a clear example of what happens when rising ownership costs outpace the value buyers are willing to pay. Its correction is already underway, and the forces driving it are still strengthening. Number 1. Miami-Dade inland areas. Miami-Dade's inland suburbs, places like Kendall, Westchester, Hialeah, North Miami, and parts of Doral, are facing one of the most complex and significant housing corrections in Florida. These aren't the beachfront condo towers that typically dominate headlines. These are residential neighborhoods where families, long-term homeowners, and local workers form the core of the market. And over the past 18 months, conditions have shifted in ways the broader statewide numbers don't fully capture. The first pressure point is affordability. Even after cooling from peak pricing, median single-family homes in many inland zip codes still hover between $520,000 and $650,000. far outpacing local earnings. With mortgage rates elevated, the income needed to qualify for a typical home often exceeds $150,000 to $180,000, while median household income across Miami-Dade remains around $57,000. This gap has created a structural demand slowdown, especially among local buyers. Inventory tells the next part of the story. Listings in inland Miami-Dade have risen by more than 35% year over year, pushing months of supply to levels not seen since the post-2008 recovery. Homes that once sold within days now remain on the market for months, triggering widespread price reductions. From peak 2022 values, inland neighborhoods have already recorded declines of 12% to 20%, with deeper drops in areas heavily affected by insurance shocks. Insurance continues to be a defining factor. Inland homes, especially older construction, have seen premiums climb into the $7,000 to $12,000 range, even without direct coastal exposure. Roof age, electrical systems, and inspection requirements have created additional friction, causing many buyers to walk away during underwriting. Investor behavior has also changed. The pullback of institutional buyers, combined with cooling rent growth, has left many formerly investor-driven neighborhoods without the demand buffer that kept prices elevated. This has accelerated downward price pressure. Altogether, Miami-Dade's inland market is undergoing a recalibration that reflects long-term affordability limits, rising ownership costs, and slowing migration. The correction is already well underway, and the forces driving it remain firmly in place. Final take. Across Florida, the same pattern emerges no matter where you look. Price corrections accelerating, insurance costs reshaping affordability, and local incomes struggling to keep pace with the true cost of home ownership. From coastal condo markets facing substantial maintenance and insurance obligations to inland communities confronting price resets after years of overheating, the pressures are consistent and increasingly visible in the data. The 10 cities highlighted in this investigation illustrate the full spectrum of Florida's structural challenges. Median prices have fallen between 9% and more than 20%. Inventory has expanded sharply as sellers adjust to new market realities, and insurance premiums now exceed mortgage payments in some regions. These forces create a feedback loop in which higher carrying costs weaken demand, softer demand pushes prices lower, and each reduction establishes new comparables that reset entire neighborhoods. Underlying these shifts is a simple economic disconnect. In many Florida markets, home prices remain far above what local incomes can sustainably support. When teachers earning $50,000, nurses earning $65,000, and police officers earning $70,000 face median home prices that require incomes of $100,000 to $135,000, the imbalance eventually resolves through market correction. That process is already underway. Price reductions, stalled listings, and growing inventory all point toward a recalibration, bringing values closer to fundamentals. What we are witnessing is not a temporary fluctuation. It is a structural adjustment. The rapid appreciation of 2021 and 2022 pushed prices far beyond historical norms, and rising insurance costs accelerated the tipping point. Whether driven by regulatory changes, reinsurance markets, or climate-related risk assessments, insurance now plays a defining role in Florida's housing trajectory. Until premiums stabilize, affordability will remain under pressure, especially for working and middle-class households. For prospective buyers, the key takeaway is clear. Markets tend to bottom when prices realign with local earning power. In many of the cities reviewed, that alignment has not yet occurred. Additional correction, whether through gradual declines or sharper step-downs triggered by distressed sales, remains a realistic expectation. Florida's housing market is transitioning from speculation-driven highs to a more income-driven equilibrium. The correction is not uniform, and it won't unfold at the same pace everywhere, but the direction is consistent: declining prices, elevated carrying costs, and demand shifting toward more sustainable price points. Families navigating this landscape should focus on long-term fundamentals rather than short-term fluctuations. If you found this analysis valuable, consider subscribing to Uncover the Cities. In our next investigation, we turn to Arizona and Nevada, two states now showing early signs of the same pressures reshaping Florida. And if you've experienced these market changes firsthand, share your thoughts in the comments. Your stories help others understand how these trends are unfolding across the country. Florida's correction is not a future possibility. It is underway, accelerating, and reshaping the state's housing market in real time. The data is clear, and the next phase is just beginning.